Welcome back to The Explainer. Today, we're diving into something really cool. A new tool that uses a whole team of AI agents to simulate one of the most complicated and frankly mysterious financial systems on the planet, the bond market.
Okay, so let's just jump right into the big question, right? Bond markets affect pretty much everything. Your mortgage, your country's debt, you name it. And yet, for decades, they've been almost impossible to predict. So what makes them such a tough nut to crack?
Well, to get to the bottom of this, we first have to understand the crime scene, so to speak. We're talking about the fixed income market, and it's famous for being incredibly opaque, kind of like a financial black box.
And this slide just lays it all out perfectly. You know, if you think of the stock market as this big, open town square where everyone can see the prices on a giant board, the bond market is totally different. It's more like a huge, sprawling city with a million little back alley deals happening all at once. There's no single price. It's all negotiation.
And that's exactly why the old playbooks are totally useless here. For years, financial models just assumed everyone in the market was a perfectly rational robot, all acting the same way. But in reality, it's a messy, chaotic ecosystem full of different players with completely different goals.
So, if you can't capture that chaos with one big equation, what do? Well, you get creative. You build an entire team of specialized AI agents to act it all out for you, basically creating a digital twin of the market.
Right, and this is the core concept behind the whole thing. An agent-based model isn't some giant formula. No, it's a virtual world. You create these individual digital agents, gives them each their own rules, and then you just let them go. The amazing part is seeing the complex, unpredictable patterns that emerge just from their interactions. So let's meet the team. First up, you've got the central bank agent. This is the big, powerful player that kind of sets the tone for the whole market. It's usually slow and methodical, acting on data, but, and this is key, if a crisis hits, it can turn on a dime to keep things from falling apart.
Next, you've got the market maker, the commercial bank agent. This one is constantly giving out prices to everyone else. When things are calm, it's cheap to trade. But when things get crazy and volatile, this agent widens the spread, the gap between its buy and sell price, and suddenly it gets a lot more expensive for everybody to make a move.
And here's our wild card, the leveraged fund agent. This is your classic hedge fund. It uses borrowed money, or leverage, to make these huge, aggressive bets. But, you know, that leverage is a real double-edged sword. If a bet goes south, it gets a margin call and is forced to sell everything right now, which can send massive shockwaves through the market.
Then you have the steady hand, the stabilizing force. The long-term investor agent acts like a big pension fund. It's not in it for a quick win. It's programmed to systematically buy when prices are cheap and sell when they're expensive, which provides a sort of anchor for the rest of the market.
And last but not least, the robot. The momentum trader is pure algorithm. It has zero idea what the economy is doing. It just sees which way the wind is blowing and jumps on board, amplifying trends and pretty much pouring gasoline on whatever fire is already burning.
Okay, so that's our team. 5 totally different players, 5 different playbooks. But how do you get them to work together in a way that actually looks like a real market? Let's take a look inside the simulation. Well, it's this super smart 3-step process. First, other agents go out and gather real-world intel, like economic forecasts. Then, our 5 market agents are unleashed to trade and react based on that info. And finally, a critic agent steps in to review the whole thing, kind of like a fact-checker, to make sure the result is actually realistic. Okay, this is where it gets really fun, because seeing the theory is one thing, but watching this team in action during a full-blown crisis, that's where you see the real power of this. Let's walk through it.
And it all kicks off with a pretty simple question from a user. Basically, hey, what's going to happen to the price of this important government bond? The system takes that prompt, and the simulation begins.
And just look at how this plays out. This is that emergent chaos we were talking about. The hedge fund goes all in, the momentum trader follows, but then the price gets too high for the long-term investor. And then comes the big one, the margin call that forces the hedge fund to dump everything. This whole chain reaction wasn't programmed in, it just happened because of how the agents interacted.
So what does this actually look like in numbers? Well, before the chaos, the cost to trade is super low, just 15 basis points, which is just a tiny fraction of a percent. The market is calm, it's liquid, it's easy to get things done.
But then, bam! After the hedge fund is forced to sell, the whole game changes. The commercial bank agent freaks out and blows out its spread to 50 basis points. All of a sudden, it's more than 3 times as expensive to trade. Liquidity has just vanished. It's a perfect simulation of a market under stress.
And that's the big takeaway, right? This isn't just some neat academic model. This is actually a blueprint for a whole new generation of tools that could help us understand and maybe even manage financial risk.
And where this tech could go from here? I mean, it's just wild to think about. Imagine being able to model how one bank failing could ripple through the whole system, or feeding it live data to see what's happening tick by tick. You could even run thousands of these simulations to map out not just one future, but a whole range of possible outcomes.
Which, leaves us with a pretty mind-bending final question. We've seen how this kind of technology can crack open the black box of the bond market. So what's next? What other huge, complex systems, from global supply chains to maybe even our own social networks, could we finally start to understand by building a digital twin?